In March 2001, 6 months before the company's first public crack, a journalist who was not on the Enron beat published an article in Fortune magazine. Her name was Bethany McLean. She had a degree in English literature from Williams College. She had spent 3 years at Goldman Sachs and then moved to journalism. She had been at Fortune for about 5 years. She was not, by any measure of the financial press at the time, a senior figure. A short seller named Jim Chanos had called her in late 2000 and told her something he found strange. He said, "The company's own filings don't make sense. You should read them." So she did. She sat down with Enron's 10K, the annual report every publicly traded company in America is required to file with the SEC, and she read it slowly. The more carefully she read it, the less it made sense. She could not figure out how the company made its money. She called Enron and asked. The investor relations team gave her answers that did not answer the question. She called again. She asked again. Skilling, by this point chief executive officer, agreed to a phone interview. She asked him how Enron actually generated cash. His response on the recorded call was that no one had ever been able to make him answer that question, and then he hung up. Then he flew to New York. He went to Fortune's offices in person to argue with the editors that the article should be killed. The editors ran the article anyway. The headline was, "Is Enron overpriced?" The article was 2,500 words. The thesis was 6. How does Enron make its money? In March 2001, that question was published on the cover of Fortune magazine, the same magazine that, for 5 years running, had named Enron the most innovative company in America. The market did not react. The stock went down briefly, then it went back up. Analysts dismissed the article. Other journalists treated McLean as a contrarian who didn't understand the business model. Fortune's own editorial board was internally divided on whether the piece should have run. The basic question had been asked, in public, on a major magazine cover, and the system was strong enough to absorb it. 5 months later, on August 14, 2001, Jeffrey Skilling resigned as chief executive officer of Enron. He had been in the role for 6 months. He gave the official reason as personal. The stock dropped 10% in a day. Analysts said the move was overdone. Ken Lay returned to the CEO role and assured investors that the company was in the best shape it had ever been in. What nobody outside the company knew in August 2001 was that Skilling had been watching the SPEs unravel from the inside. The hedges in the Raptor structures were collateralized with Enron stock. When the stock was rising, the hedges looked fine. When the stock was falling, the collateral was evaporating. When the collateral evaporated, the hedges failed. When the hedges failed, the losses that had been hidden inside the SPEs would come back onto Enron's balance sheet. Skilling did not announce any of this. He just resigned. 6 days later, a vice president in Enron's corporate development group sat down at her desk and wrote an anonymous memo to Ken Lay. Her name was Sharon Watkins. The memo was 7 pages. It identified the Raptor structures by name. It explained why they were going to collapse. It listed the conflicts of interest in the LJM transactions. It used language that would, later, become some of the most quoted in American corporate history. "I am incredibly nervous that we will implode in a wave of accounting scandals." And, "It's a bit like robbing the bank in 1 year and trying to pay it back 2 years later." The memo went to Ken Lay. Lay's response was to hire Vincent & Elkins, the same law firm that had approved the structures in the first place, to investigate the allegations. V&E cleared the company. Watkins was reassigned to a different department, not fired. Firing her would have created a paper trail. In her memo, Watkins had named one other person who understood what the Raptor structures were, a man named Cliff Baxter, the vice chairman, who had been arguing against the LJM transactions internally for over a year before quietly resigning in May 2001. 6 weeks after the bankruptcy, Baxter was found dead in his car on a residential street in Sugar Land, Texas. The police determined it was self-inflicted. He had been scheduled to testify before Congress about Enron. He never did. By autumn 2001, the question had been asked. Twice. Once from the outside, a journalist on a magazine cover, asking how the company made its money. Once from the inside, a vice president in a 7-page memo naming the structures that were about to collapse 6 months before they did. Both warnings reached the people who could have stopped it. Neither of them changed what happened next. The system was still strong enough to absorb the warnings, until, suddenly, it wasn't. October 16, 2001. Enron announces a $618 million quarterly loss, a $1.2 billion reduction in shareholder equity. The CFO walks the analysts through it. The numbers don't reconcile. The market starts asking questions for the first time in 5 years. October 22nd, the SEC opens a formal investigation. October 24, Andrew Fastow is fired as CFO. November 8, Enron restates earnings for 1997 through 2000. $586 million in previously reported profits erased. The SPEs that had been off the books are pulled back onto the books. The Raptor structures, by name, are disclosed. Stock falls to $7 from $90 1 year earlier. November 28, credit rating drops to junk. Trading counterparties stop trading with Enron. Banks stop lending. Suppliers stop shipping. A company that had been the 7th largest in America 4 weeks earlier can no longer pay its bills. December 2nd, 2001. Enron files Chapter 11 bankruptcy, largest corporate bankruptcy in American history at the time. When a company this large collapses, the court appoints someone to clean up what's left. The man they brought in was named John J. Ray III, the most famous corporate restructuring specialist who had spent 2 decades cleaning up America's largest bankruptcies. After the announcement came the people. 21,000 employees lost their jobs.
I worked at Enron for 18 years. I lost all of my retirement money, which was over $500,000.
But the job loss alone was not the worst of it. Most of them had their retirement savings in Enron stock. Encouraged by management, matched by management, sustained by a corporate culture in which selling your Enron stock was considered a vote of no confidence in the company. Here's what happened during the final weeks. In October 2001, as the stock was beginning to collapse, Enron's 401k plan went through a routine administrative changeover. The company switched 401k plan administrators. During the transition, employees were locked out of their accounts. They could not log in. They could not check balances. They could not, most importantly, sell. The lockdown was supposed to last 10 business days. It lasted nearly 3 weeks. During those 3 weeks, the stock fell from approximately $15 per share to less than $1 per share. Employees sat at their desks and watched it happen on the live ticker on the trading floor, a ticker that, in better days, had been the source of company pride. They could not act. The button did not work. Executives had no such restriction. In the months leading up to the bankruptcy, Kenneth Lay personally sold approximately $300 million in Enron stock, while telling employees in company-wide meetings that the company's stock was a bargain and that they should buy more. There is a recording of one of those meetings. He says on the recording, "I think the 3rd and 4th quarters are going to be strong. I think we're going to hit our numbers." By the time the 401k lockout lifted, the stock was worth almost nothing. The retirement savings of 21,000 people were gone. A pipeline engineer in Houston who had worked at Enron for 26 years. His pension? Gone. A mid-level energy trader who had spent 11 years at the company. His daughter's college fund? Gone. A receptionist in the Houston headquarters who had bought stock through the employee stock purchase program every 2 weeks since she had been hired. 18 years of contributions. Gone. A retired vice president, 73 years old, who had taken his entire retirement in Enron stock because the company had told him it was the safest investment he could make. Gone. These were not abstractions either. The creditors fought over what was left. The banks paid fines and moved on. The executives, eventually, went to court. But the employees, the ones who had no role in the fraud, who had simply showed up, done their jobs, and trusted the institutions around them, they got nothing, or close enough to nothing that the distinction did not matter. A class action settlement, years later, would return approximately 12 cents on the dollar to the employees' retirement plans. 12 cents of every dollar they had been told was safe. The trials lasted years. Andrew Fastow, the architect of the SPEs.
The only reason I'm standing here today is because I went to prison.
The CFO who personally profited $45 million from the structures he built, pleaded guilty in 2004 to 2 counts of wire fraud, sentenced to 6 years in federal prison, reduced for cooperation, released in December 2011 after serving 5. Today, Andrew Fastow gives paid corporate ethics talks at universities and conferences. He has appeared at the University of Colorado, at Tulane, at the Association of Certified Fraud Examiners. He has been paid speaking fees. He's been treated as an authority on ethical decision-making. The man who built the fraud is now paid to explain why fraud is wrong, while the families he defrauded are still, 2 decades later, picking up the pieces of their lives. Richard Causey, Chief Accounting Officer, the man who made the numbers work on paper, pleaded guilty to securities fraud, sentenced to 66 months. Jeffrey Skilling, Chief Executive Officer, the man who built mark-to-market into a belief system, convicted on 19 counts of fraud and insider trading in May 2006, sentenced to 24 years in federal prison. In an appeal deal years later, the sentence was reduced to 14 years. He served 12, released in 2019. To this day, in interviews, Jeffrey Skilling maintains that he did nothing wrong and that the company he ran was destroyed by a market panic and a federal prosecutor with a vendetta.
Jeff, do you think you will ever be able to admit to yourself that you may have committed crimes?
No.
Why not?
12 years in federal prison did not change his answer. Kenneth Lay, Chief Executive Officer, the founder, convicted in May 2006 on 10 counts of conspiracy, securities fraud, and wire fraud. He was scheduled to be sentenced on October 23, 2006. On July 5, 2006, 3 months and 18 days before his sentencing, Kenneth Lay died of a heart attack at his vacation home in Aspen, Colorado. He was 64 years old. Under federal law, when a criminal defendant dies before sentencing, the conviction is abated, legally vacated, as if it had never happened. The conviction against Kenneth Lay was erased. The federal government, which had been preparing to seize his assets as part of the criminal forfeiture, lost the legal basis to do so. His estate kept the wealth, the mansion in Houston, the compound in Aspen, the art collection, the private jets, the retirement accounts. The retirees who had taken his advice and held their Enron stock kept 12 cents on the dollar. The Lay family kept the houses. Arthur Andersen, the accounting firm, founded in 1913, 90,000 employees globally. Convicted of obstruction of justice in 2002 for shredding Enron-related documents. In 2005, the United States Supreme Court unanimously reversed the conviction on the grounds that the jury instructions had been legally defective. By the time the reversal came, Arthur Andersen had already collapsed. 85,000 jobs lost worldwide, clients gone, partners scattered. There was no retrial. There was no second chance to hold them accountable. The conviction was erased. The shredded documents were not. Fastow at the lectern, the empty office. The fraud was real. The trials were real. The convictions were, in 2 of the 4 most important cases, legally erased. Kenneth Lay by death, Arthur Andersen by procedural reversal. The men who built the fraud had walked away with more than the employees who believed in them ever got back. Retirees got 12 cents on the dollar. Fastow got a speaking circuit. Lay's estate got the houses, and Andersen's reversal got filed under legal technicality. Most people watching this think they're watching a story about an accounting fraud. You're not. You're watching a story about what happens when an entire system of professional checks decides, independently, without coordination, in good faith, that asking the question is somebody else's job. Enron didn't fail because one man lied. It failed because every institution paid to catch the lie had a reason to look the other way. The auditors had fees. The lawyers had retainers. The banks had deal flow. The analysts had access. The board had board fees and stock options. The regulators had revolving doors back into the industry. The journalists, mostly, had been told that the company was too sophisticated to question. Each one of those institutions could have caught Enron. Each one of them had access to the documents. Each one of them had the technical expertise to read the documents. And each one of them, individually, made a series of small, plausible, professional decisions that in aggregate allowed the fraud to run for a decade. Not one of those decisions, on its own, looked like complicity. Every one of them, together, was. This is the part of the story that gets lost in the courtroom footage. Enron's fraud was not hidden. The conflict of interest was disclosed. The board approved it in writing. The special purpose entities were named, in filings, with documented relationships to executives. The mark-to-market accounting was published quarterly. The structures were visible to anyone who read the 10K. The fraud was all in the documents. It was all on the record. And the reason nobody acted on it was not that they couldn't see it. It was that saying it, out loud, in public, would have made them look like the only person in the room who didn't understand the business model. In an industry where the price of looking smart was $1 million bonus, and the price of looking stupid was the end of your career, saying what no one else was willing was the move that ended you. So everyone kept their mouths shut and their pockets padded, and the fraud ran for a decade. After Enron, the United States Congress passed a law called the Sarbanes-Oxley Act. CEOs and CFOs are now required to personally certify their financial statements. Auditors are barred from also being consultants for their audit clients. Boards face stricter independence rules. Those rules did not exist before Enron. They exist now because of Enron. Some people will look at that list and conclude that the lesson of Enron is more government. That's not the lesson. The lesson is that markets, left entirely to themselves, do not generate the friction they need to function honestly. Auditors don't audit the client who pays them. Analysts don't downgrade the company that grants them access. Banks don't refuse the deal that hits the quarter. And boards don't ask the question that would admit they never understood the meeting. The friction has to come from somewhere. It can come from regulation. It can also come from journalism, from whistleblower protection, from criminal liability that actually reaches the executive suite, from mandatory disclosure that makes the basic question unavoidable, from short sellers who get paid to be skeptical when nobody else will be, from a culture that protects, instead of punishes, the person who asks the question that makes the room uncomfortable. The form of the friction is a debate worth having. The need for the friction is not. Because the alternative is the system that produced Enron. A system in which every professional check existed, every box was ticked, every signature was obtained, and the fraud ran anyway. Not because nobody could ask the question. Everybody could. But everybody responsible for keeping things in check was being paid. In fees, in access, in bonuses, in board stock, to sign off anyway. The question Bethany McLean asked was not difficult. How does Enron make its money? It was 6 words. A college student could have asked it. A reporter who had read the company's own 10K could have asked it. Any analyst on any of the calls could have asked it. The reason it took a journalist who wasn't even on the Enron beat to ask it in public was not that the question was hard. It was that, inside every institution paid to ask it, asking it would have cost more than not asking it. That's the disease. And before you decide this is a story about other people, the executives, the auditors, the analysts, the board, understand that the mechanism that built Enron is not a finance mechanism. It's a human one. Enron's professionals stayed silent because dissent cost them a bonus, a promotion, a career. You also stay silent, but for something far more powerful than money. You stay silent because disagreeing out loud, at the dinner table, in the group chat, with the people you've known for 20 years, might cost you the friendship, the invitation, the feeling that you still belong. And belonging isn't a small thing. It's one of the deepest needs a person has. We are wired to choose the group over the truth, because for most of human history, losing the group meant dying. So you nod, you let it pass. But here's the part that should sit with you. It isn't only that you stay quiet. It's that when someone else speaks up, when someone questions the thing your group has agreed to believe, you also turn on them. You roll your eyes. You stop replying. You decide they've changed, that they've been radicalized, that they're not worth talking to anymore. You don't just avoid speaking out. You are complicit in enforcing the silence of everyone around you. That's the part nobody wants to admit. We are not just the analysts who didn't downgrade the stock. We are the reason the next analyst won't either. Look at the beliefs you hold, not because you examined them, but because examining them might put you on the wrong side of the people you love. Look at the last time someone in your life questioned something you believed, and ask yourself, honestly, whether you considered their argument or whether you just decided they were the enemy. Enron is what happens when nobody asks. It is not rare. It is not historical. It is the default state of any group, a company, a market, a friendship, a country, where staying in the group has become more important than being right. Power is not built on innovation. It's built on silence. The silence we keep and the silence we enforce. And ruin begins the moment loyalty to the group outweighs loyalty to the truth. John J. Ray III spent 2 years reconstructing what was left of Enron. 21 years later, he was called in again. Different company, different fraud, different generation of believers who had been told that the rules didn't apply to them. The company is FTX, and the story of that $32 billion collapse is already live on this channel.